On March 21st, ON holding stock surged 26% and another 12% the following day after posting better than expected Q4 earnings results as well as announcing guidance that took the markets by surprise. After doubling from its 52-week lows, is this the start of a multi-bagger story? In this video, we'll do a deep dive on ON running and find out if the stock is still worth investing at current levels. What is going on, guys? My name is Riado, and if you're new to this channel, I do stock market research and analysis on some of the most innovative companies in the world and help you guys find the companies of tomorrow. If that is something that you guys like to hear, don't forget to subscribe so you won't miss future videos. If you like to read the article version of this analysis, which is way more detailed than this video, you can find the links to my article in the description below. With that said, let's take a look on ON running, ticker symbol ONON. So ON running offers innovative, high-performance premium footwear, apparel, and accessories for running, outdoor, and all-day activities. The company was founded in 2010, and it all began when retired athlete Olivier Bernhard, a multiple world duathlon champion and multiple Ironman winner, wanted to create a running shoe that will give him the perfect running sensation. So Bernhard developed a prototype by gluing pieces of a garden hose to a running shoe. He took it for a test run, and that's when he felt something unusual. He felt like he was floating and he was like running on clouds. So excited by his new invention, Olivier reached out to two of his friends, David Ellman and Kaspar Kopetti, which all of them together became the co-founders of ON running. So ON was formally established in January 2010, and their goal was to create the most high-performance running shoe ever. So in the following years, ON began taking off as the company kept winning awards and its brand continues to grow, especially when Roger Federer, the tennis legend, invested in the company. And just less than 2 years ago, ON went public and now they are worth almost $10 billion. So at the very core of ON running, it is its premium footwear. The company specializes in running shoes but has since expanded into other categories such as tennis, hiking, and trail running, and even lifestyle sneakers. They are priced at a premium, but their high quality construction, futuristic and unique look, and advanced technology really justifies the premium pricing. So there are three distinct features that form the foundation of each ON running shoe. First is Cloud Tech, which is the little cloud-like pods that run the whole length of the sole. They are pretty much the cushioning system that delivers soft landings and powerful takeoffs. Then there's the Speedboard, which is a responsive, semi-stiff board that increases the run speed by converting the kinetic energy of each landing into a more explosive takeoff. And finally, there's Helion. So the CloudTech sole in all ON shoes is made of Helion, which is ON's proprietary super foam that is lightweight, flexible, and responsive. It allows for smooth and effortless runs. So besides shoes, ON also sells apparel and accessories as well. So the opportunity for ON running is the increased popularity in sports running. Running brands are currently seeing sales increases of up to 60% to 70%. The running gear market alone is quite massive. It is worth $23 billion in 2022 and is expected to grow to $62 billion by 2030. So this is just the running gear market alone, and ON running has tons of optionality in terms of expanding into other markets, including other categories such as basketball, yoga, connected fitness, weightlifting, and so on. So there's a lot of room for growth for ON running. Now let's dive into ON's financials, starting with its growth metrics. And since ON running is a Swiss company, they report their numbers in Swiss francs. So for full year 2022, they have a revenue of 1.2 billion Swiss francs, which is an increase of 69% year over year. In Q4, they have 367 million, which is an increase of 92% year over year. As you can see, the company is growing at a massive clip. The growth in Q4 of 92% really demonstrates the strong brand of the company as well as strong demand for its products. So the normalization of inventory levels and supply chains was also a key contributor to growth, as there were, pandemic lockdowns and restrictions during the later part of 2021. So if we look at revenue by channel, we can see that wholesale is growing at a massive pace, which is 104% year over year increase in Q4, which is growing way faster than its DTC channel, even though the DTC channel is still growing and it's still the smaller part of the business. So the outperformance of the wholesale segment is due to growth within existing and new wholesale partners, and wholesale stores increased from 8,000 at the end of 2021 to 9,200 in 2022. So wholesale revenue as a percentage of revenue increased to 59% in Q4 as compared to 56% a year ago. The reason for this expansion were the strong recovery in wholesale stores following lockdowns and shopping restrictions. The DTC channel, on the other hand, only makes up 41% in Q4, and in my view this figure is going to increase as the company expand its company-owned retail stores and more people gain awareness in the brand. In terms of geography, revenue growth was robust across all channels. As you can see, Europe grew by 81%, North America by 81% as well, and Asia Pacific 104%, and the rest of the world at 679%. So this was due to growth across all channels and the stabilization of supply chains as well as pandemic restriction easing. So as a percentage of revenue, Europe and North America make up the bulk of total revenue at 22% and 66% respectively, although Asia Pacific only makes up about 6% of the total business. There's substantial growth opportunities, growth potential in this region, especially in China, as the growth of the company's upper middle and high income groups is expected to significantly increase demand for premium sporting good products like on running. So switching over to product type, shoes saw the largest increase in Q4, reaching 353 million Swiss francs, which is a 97% year-over-year increase. This was due to strong demand during the holiday season, as well as updates to existing models and the launch of new products in 2022, such as the Cloud 5 and Cloud Monster. So all in all, On showed explosive growth despite the challenging macroeconomic environment. Elevated brand awareness and continued retail expansion were the drivers of growth, and I expect that to continue. On still has massive growth opportunities ahead as it can expand to other categories, other geographies, and even other product types. So as the company introduces new technologies, new product categories, and increase its brand awareness, I think the only way is up from here. So now let's take a look at the profitability of the company. For full year 2022, On Running produced 685 million Swiss francs, which is an increase of 92% year over year. This represents an industry-leading gross margin of 56%, which is way higher than its peers like Nike, Under Armour, and Allbirds. So as you can see here, this is how the gross margin profile has trended over the last few quarters, and it is slightly below 2022 levels, and this is because of supply chain constraints during 2022. So the reasons are higher air freight expenses, currency exchange headwinds, as well as the explosive growth in the wholesale segment, which has typically lower margins than the DTC channel. Nonetheless, they still maintain industry-leading gross margins, which means higher earnings potential compared to peers. So turning to operating profit, On Running produced 85 million Swiss francs, which is a 7% operating margin. But as you can see, there's a dip in Q4 in operating margins, and this is due to higher share-based compensation expenses as well as selling expenses. Anyways, as the company achieves economies of scale and as key markets mature and the supply chains continue to improve, I expect the operating margins to increase as the company achieves operating leverage. Now let's take a look at the bottom line of the company. For full year 2022, it was a 5% net margin. However, in Q4, you can see that it dipped to -7%, which is a -26 million Swiss franc in Q4. Now, the reason for this is the higher SBC expense as well as currency exchange headwinds in Q4. So just for reference, you can see that adjusted net income is positive throughout 2022. Adjusted EBITDA is also positive in the last few years, especially in Q4. It's at 17%, which is the highest it has ever been for the company, producing 62 million Swiss francs in adjusted EBITDA. Now, adjusted EBITDA excludes SBC expenses as well as currency exchange headwinds. So in terms of profitability, ON has strong earnings potential and demonstrated that it has operating leverage within its business model. The real competitive advantage, in my opinion, is the superior margin profile, which means higher earnings potential compared to peers, as well as more profits that it can reinvest into the business. Now let's take a look at the financial health of the company. At first glance, ON seemed to have a very strong balance sheet. It has 397 million Swiss francs in cash and short-term investments. Total debt is only 160 million, which brings its net cash position to 237 million. The company also has a current ratio of 4 times, which is quite liquid. However, the company doesn't seem to be managing working capital efficiently. As you can see, ON running is burning lots of cash. Full year 2022 free cash flow was negative 287 million Swiss francs. This was due to a 145% increase in net working capital as the company builds inventory in anticipation for strong demand. The company is also reinvesting into growth and expanding its retail presence and offices around the globe. So that is why you can see the large cash burn in the better part of 2022. But this level of cash burn is not sustainable in my opinion. It is way too high, and if it stays the same in 2023, we can see net cash position being completely wiped out in 2023. And if that happens, ON may be forced to raise additional capital, maybe in the form of debt or equity, which can dilute shareholders. And at the same time, ON may be forced to offload its inventory at large discounts, which can really hurt its brand reputation as a premium footwear, apparel, and accessories company. So all in all, I can't say that ON has a strong balance sheet, and I think the company needs to manage its working capital more effectively and efficiently. Before we move on, if you like this video, I would appreciate it if you can like, comment, and subscribe to my channel, as it helps to grow the channel and reach more people like you. So in terms of outlook, management provided the following guidance in its Q4 earnings release. So the momentum across all regions, channels, and product groups, as well as normalization of product supply and significantly improved inventory positions them well in 2023. So that means a net sales growth rate of 61% in the first quarter of 2023, which is incredible. And the company also expects net sales of at least 1.7 billion Swiss francs for the full year 2023, which is a year-over-year growth rate of 39%. And if the company excludes currency exchange headwinds, it is a currency neutral growth rate of 42%. So the company also expects air freight usage to decrease in 2023. There's going to be a strong inflow of recent products which will be sold at full price. So that means the company can maintain high gross margins, gross profit margin expansion towards the stated midterm target of 60%. And that's why for full year 2023, the company expects gross margins to be approximately 58.5%. So with the higher gross margins, the company expects to reinvest into growth, re-accelerating marketing expenses, which is why adjusted EBITDA margin is expected to increase to 15% in 2023. So all things considered, the initial guidance provided by management is shockingly good, which is why there's such a really positive reaction to the stock following its recent earnings release. But I think management is being quite conservative here. As you can see this chart in Seeking Alpha, it shows the revenue surprise, what the company actually produces in revenue versus the analyst estimates. So as you can see in the last few quarters, as as a public company, On Running actually beat analyst expectations by huge margins. So I think there's a really good chance for On Running to continue to outperform expectations, whether it be internal guidance or analyst estimates. So what are the competitive advantages of the company? I think technology is one of its competitive moats, as shown by the multiple ISPO awards that the company has, which are one of the most prestigious awards when it comes to sports innovation. So On is also very innovative in the production side, where they focus on two key areas: using alternative materials and creating circular systems. So one such example is Clean Cloud. So most recently, On partnered with LanzaTech, Borealis, and Technip Energies to capture carbon emission to create Clean Cloud, which is a high-performance EVA foam for outsoles. So this is a really exciting development, and the company is expected to launch the first ever shoe made from carbon emissions, called Cloud Prime. So another example would be the launch of Cyclone. Cloud Neo is the first shoe under the Cyclone program, and it is made entirely from sustainable materials, more than 50% of which is made from castor beans. So it's a subscription model where customers pay $29.99 per month for a pair of running shoes, and after 6 months, customers can request for a new pair of shoes. So the old dirty shoes are then sent back to On, where they will be 100% recycled. So from an investor standpoint, 100% recyclable means that cost of goods sold goes down to near zero. And the subscription model means stable, consistent revenue stream. And in other words, Cyclone has the potential to produce software-like revenue and margins, which will be accretive to the company's gross margins as well as earnings potential. So there's something that investors should be excited about. The second competitive mode of the company is the brand. I think the company is unique. Their shoes feel different, their shoes feel premium and techy, and the technology is like no other. So On's brand power is displayed in its explosive growth. So as you can see here, the active apparel and athletic footwear markets where On operates in, they actually saw a decline by 3.9% and 6.1% respectively in 2022. So while the sporting goods industry declined as a whole, On's business continues to take off and they continue to grow, which shows that the brand is really strong. And last but not least, I think its focus in sustainability and producing sustainable fashion is going to win a lot of customers as the world becomes more and more environmentally conscious. And last but not least, I think the company has cost advantages moats. As you can see here, the company has superior margins compared to its peers here. So On Holding has a gross margins of 58.5%, while companies such as Lululemon, Nike, Under Armour, Adidas, and Allbirds have way less than that. And as the company grows its DTC business, which has high gross margin profile, I expect gross margins to continue to improve to 60% and even in the low 60s. And with that cost advantages mode and superior margin profile, it means higher earnings potential that can be reinvested into the business. Now let's take a look at the valuation of the company. You can see how On Running's EV to revenue multiple looks like over the last few quarters. The company is now trading at 6.9 times EV to revenue multiple, which is trading more reasonably than its peak of 20 times. However, I think this is quite expensive for a retail company. If we head on to On Running's valuation grade and underlying metrics in Seeking Alpha, we can see that On Running has a valuation grade of F, which is pretty bad. And if we compare its valuation to peers like Lululemon, Nike, Adidas, Under Armour, and Bird, we can see that its EV to sales multiple is much higher than them. And do note that On Running has significantly higher revenue growth rates and potential since it is smaller and since it's growing. So therefore, I think the higher EV to sales multiple is well justified. And in terms of analyst price targets, we can see that there's a low of $19 to a high of $39, which brings the average price target to $32.5 a 10% upside from current levels. So I did a DCF analysis on my own, and I've included that in my article in Seeking Alpha. If you're interested in looking at that, the details of it, you can find the links to my article in the description below. So based on my DCF analysis, I came to an intrinsic value of $30 per share, which is not much upside from current levels. And given that this is a high growth, unprofitable company, I would like to have a larger margin of safety if I were to invest in this stock. On another note, management has skin in the game, having a large insider ownership on the stock of about 29.5%, so that should be a confidence booster for investors. So what are the risks for the company for ONON as an investment? So I think competition is the first one. The sporting goods industry is highly competitive. There are giants like Nike and Adidas. There are running specific brands such as Hoka and Asics. There are premium sports performance brands like Lululemon and Noble. So ON needs to build its brand as an innovator in the sports industry, and they need to maintain that. And if not, growth may not turn out as good as expected, which is going to be a risk to the stock. So the second risk is management. So if we head to Glassdoor, we can see that ONON's rating is about 3.4 stars out of 5, and we can see that the overall trend has been downwards ever since the company went public. So I think this is something to keep an eye out for, because management and the people are ultimately the people that grows the company, and ultimately they will be the ones that drive shareholder returns. So this is something to keep an eye out for. And last but not least, manufacturing concentration is one of the biggest risks as well. According to its annual report, in 2022, 95% of ON's footwear products and 60% of its apparel and accessories products were produced in Vietnam. Furthermore, 5 out of its 22 suppliers produce approximately 70% of its products in 2022. If operations in Vietnam or its top 5 suppliers are disrupted, ON's operating results could take a big hit. So something to consider when investing in ON stock. In conclusion, I really like the company. It has strong brand, strong technology, and cost advantages moats. It has strong growth metrics and superior profitability as well. And the company has a long growth runway. It has tons of optionality to expand to other products and to other markets. The company also released really good Q4 earnings, and management provided really strong guidance as well. I really like the company, but I don't necessarily like the stock. By my estimation, the company should be worth about $30 a share, which means that I want a larger margin of safety when investing in a high growth stock like ONON. The company is also burning lots of cash, as seen from its negative free cash flow. Thus, I'd be more interested if the company trades at about $20 a share. So what about you? What do you think of ONON stock? And what companies are you watching? Is there a specific company that you want me to cover in this channel? Please let me know in the comment section down below. With that said, thank you so much for watching this video. If you like the video, please leave a like, share, comment, subscribe to my channel so you won't miss future videos. Thank you. I'll see you guys on the next one.